Members of analysts this morning struggling to find consensus.
It's not just that we don't know what the destination is. We don't know what the journey is. Also, there's disagreement as how quickly will Fed officials go from backward-looking data dependence to forward-leaning. So we have this disagreement both within the FOMC and also between the market and what seems to be the consensus, if there is one, on the Fed. So this is, for me, it's a fascinating time, but it is also a very confusing time.
I think most of us are confused. So here's the latest. Investors bracing for the Fed's first interest rate cut in more than 4 years and looking for answers to a lot of big questions. Torsten Slok of Apollo saying, despite surveys showing that the consensus expecting a soft landing, rates markets are pricing in a full-blown recession. The Fed's R-star model says that neutral monetary policy would mean a Fed funds rate at 3%. But maybe this estimate is wrong. Torsten joins us now for more. Torsten, good morning to you, sir. We've got a lot to work through. When they sit around on the committee and they continue the conversation today, if it does indeed to continue, and they ask themselves, what's the biggest risk here? Upside risk to inflation or downside risk to growth? What else do you think they come up with?
I think that they would look at the dual mandate. And it is absolutely correct that inflation was 9.1 in the summer of 2022, and now it's 2.5. So we've come a long, long way when it comes to inflation. But the other side is the dual mandate, namely full employment. Yes, the unemployment rate has gone up a bit, but literally all other economic activity indicators, real indicators for everything across GDP, as you saw yesterday, industrial production, retail sales, remain quite strong. So now you begin to sit and look at the real side of the economy and say, should I put a lot of weight on the unemployment rate going up a bit largely because of labor supply, or should I put more weight on all the other real economy indicators are actually still in relatively good shape? So I think that they would do it from the perspective of saying, what's the dual mandate saying, and where are we on the various indicators on the side of the dual mandate?
So do you take issue today with the decision of reducing interest rates, or take issue with the conversation about them returning back to 3% quickly?
So I do think that it is the returning back to 3% that's problematic, because the 3% number, the R-star number, or the terminal estimate that they have put out in the dot plot that they now literally have on the New York Fed homepage, that R-star where we're going is 3%. That turns out to be wrong, because if this were the case, monetary policy would be much more restrictive. And the incoming data, when you look at it, Atlanta Fed GDP now at 3% yesterday, that's not restrictive. If you look at what happened to industrial production yesterday, that's not restrictive either. If you look across the board on a wide range of indicators, it doesn't look like monetary policy is particularly restrictive. Most importantly, in credit and in private credit, you're seeing that loan default rates are going down. If we had a recession, default rates would not be going down, they would be going up. Even if we had a slowdown, it would be the same. So given this vast majority of indicators, when you look out of the window, still telling you that things are actually still okay, then it is problematic to sit there with high conviction and saying that monetary policy is very restrictive.
We're in a kumbaya kind of mood. We're trying to find consensus. And one thing that strikes me about what you said is it doesn't sort of really reduce the need for a 50 basis point rate cut today. You're just saying longer term, maybe they should push back against some of the expectations for 200 basis points of reduction quickly like that to get down to that level that is closer to what may be neutral. Is that correct?
Well, if our style, where we're going, the terminal Fed funds rate, if we think that's 3, but it actually is more like 4, 4.5, then you're not in a rush to cut 50. Then you could just take 25 and say, if we need to get to 4.5, that's just 75, 100 basis points lower than where we are. So there's no need to hurry to lower interest rates if you have that we don't need to get quickly down to 3, but we just need to get to 4.5. So it does become quite important whether it's 25 or 50, because it signals whether we are in a hurry to do something or whether we still have time to look at the incoming data that still continues to be strong.
What in the incoming data makes you concerned about a reacceleration of inflation, which would be the other side of the mandate that could potentially be negative if the Fed were to cut overly aggressively?
Well, one obvious area is, of course, housing. Given housing has a weight of 35% in the CPI basket, but now you see the NHB has begun to increase. Of course, if you lower mortgage rates dramatically, as we've seen here over the last 3-4 weeks, that will also give a boost to housing. We're seeing some of the housing indicators show signs of turning around, and with an already low supply of houses and therefore inventory being very, very low by historical standards, you could have that housing inflation. At least if you take the chart of Case-Shiller and overlay that with OER, it does look like we could get a rebound over the next several months in the housing components of the CPI.
If the Fed comes out and cuts 25 basis points, but Powell has very dovish language, would that be to the markets almost equal to a 50 basis point cut?
Well, I do think that exactly the communication around what they do today, so I think that they will go 25, but if they do go 50, how they talk about this will be extremely important. So that's why the dot plot coming along today with a statement is very, very critical for rates expectations. Markets are obviously pricing 10 cuts through this cycle, which is basically based on the idea that we got to get down to neutral, and 3% as quickly as possible. But if the dot plot suddenly now tells you, well, maybe you're not getting 10 cuts, maybe we're getting only 6, 7 cuts, then of course that will also mean that markets will look at that and say, well, maybe we are overpricing this, and maybe we are too hooked on, the model in the Fed's basement, namely our star, rather than going up into the living room and looking at the incoming data.
I want to ask you a quick question on fiscal. The U.S. government every day pays out billions when we pay out our interest.
$3 billion.
With the Fed cutting, how much less money does the government actually need to pay on our interest?
Yeah, so we calculated that if the Fed cuts 1 percentage point, the interest payments on a daily basis will decline from $3 billion to $2.5 billion. But that's still a very, very significant number relative to where we've been historically. So you're absolutely right. Lowering interest rates helps in terms of debt servicing costs. But in the background, we, of course, still have debt levels continuing to rise. And that's, of course, creating challenges for the fiscal situation. Maybe in the near term, it will be a little bit of relief. But down the road, this problem is, of course, not going away.
Are we suggesting John Williams is in the basement?
Well, I'm just saying that the focus here on what it is that is the narrative. Also, if you think carefully about what is the ECB saying, what is the Bank of England saying, they are not framing their decisions for monetary policy according to some, academic Kalman filter for what's happening with our star. They are framing their debate as what is the incoming data doing. So in that sense, I love our star, and I think everything that goes into it, and trust me, I spent a lot of time thinking about, and I have a PhD in economics. It is a very interesting thing to spend time on. But I'm just telling you that if you think about the incoming data, then putting it up on the scale, maybe the incoming data should get a bit more weight.
Get out of the basement and get in the living room and look out the window.
Nobody puts John Williams in the basement. All I can say is, there is this feeling that maybe we are making a little bit too much, or placing too much emphasis on certain measures that are, fuzzy or dusty.
Jim Bianco of Bianco Research made this point. There's a great divide right now, going into this decision between market pricing and economists. In our survey, more than 100 economists surveyed in our survey. Not even 10% of them think a 50 basis point cut happens today. That's how big the spread is between professional economists at the moment and market participants.
How do you make a move that is outsized at a time where you're only able to see lagging indicators and the data itself is kind of contradictory? We're seeing different signals from, say, the mortgage market versus, say, auto loan delinquencies.
Torsten, this was wonderful. You're one of the best and we appreciate it. Thank you, sir.